So today's session, I really want to talk about directors and officers insurance. It's something that I feel most people don't know about, or if they've heard about it, they think it's very much applicable to large corporate multinational companies or companies that are publicly listed. But actually what I'm going to go through today is, just highlighting why it's an important cover, and maybe it's something that you need to protect yourself as a director and your business. So if you have any questions, feel free to pop it in the chat. I'm going to try and manage that whilst going through the presentation. If I don't manage to see your question whilst I'm going through it, we'll have some time at the end anyway. I don't think it's going to take a full hour, this whole presentation. I'd like it to be as interactive as possible anyway. So to start, I thought what would be important really is to kind of like explain what does it actually mean to be a company director. We kind of advertise this webinar to be for founders of companies. See, you don't have to be a founder to understand about this, but we thought that might be a good audience to talk to about a D&O policy. And most founders are directors on a company, but what does that actually mean, right? So being a company director is really being, you're managing the affairs of the company. In a large corporation setting, you're the boss of the management. You sit on the board, you've got to make decisions that's really in the best interest of the company. So it's the highest level of the company, basically. And specifically in Singapore, there are some things around that, like you have to be a Singaporean citizen, PR, or an entre pass holder. So it's not like everyone can kind of be one. And also I think you need to be like a fit and proper type of person, because it is really being in charge of the affairs of the company. And really what we want to talk about today is what are the risks to directors, and specifically for startups. When we talk about director risks, it's always in the context of company mismanagement. We know mistakes happen, and no matter how careful you are, mistakes always happen. And this directors and officers insurance is really there to protect you in case these mistake happens when it comes around to managing the company. So the insurers like to use this word wrongful acts. And what a wrongful act means, it can mean things like failing to comply with the different regulations, the laws, wherever you're doing business in, misrepresenting information such as your company financials, even marketing type materials, and also errors or omissions in what you're doing and as part of your job as management. So this is applicable to any sort of company, right? In any sort of company, you're operating in a jurisdiction with laws and regulations. So no matter where you're at, SGX listed, NASDAQ, whatever company, you also have laws to abide by, or if you're a really small startup, right? What I think is more interesting for startups is that startups are generally trying to push the boundaries, right? And then when you take startups that are in the realm of fintech, let's say, or health tech or med tech that are much more regulated, that becomes potentially much riskier. So I always like to use the example of Uber. I mean, Uber's just a great startup example in general. They have faced so many different regulatory hearings and investigations from the taxi industries across how many countries that they operate in, right? Because they've been pushing the boundaries. They were changing the way the taxi industry worked, and naturally the unions and the taxi, everyone's just like, hey, what's going on? This is, you're never getting to our territory. Let's push back on this. And so you start to get regulators and different official bodies not being so comfortable. They're out of their comfort zone now, and so they start to push back. And so that's an area where, for being a director of a company, that becomes risky to you, because now the normal regulatory bodies are now paying attention, and they have questions to ask, and all these things. When they have questions to ask, that means you need to get a lawyer involved, and fees rack up pretty fast and pretty high as well. And one more thing to add about the risk specifically to directors is company assets cannot pay for the legal fees of a director if the director's been individually named in a lawsuit or an investigation. So it's your personal money that's paying for a lawsuit, and legal fees are not cheap. So that's something that is quite risky. And I think it's a very big misconception, because people think, right, I've got a limited liability company, I'm protected by that. If something happens, well, it's a company and it's limited, right? But actually, when you're a director and it becomes your neck on the line, it's also your personal assets on the line, which can be pretty scary. So what I wanted to move on to next is what is a D&O policy, and what is it really there for, and what does it actually cover, right? So I talked about these wrongful acts. It's really there to cover your legal fees. I just mentioned legal fees are really expensive. I mentioned if you get summoned by NAS or MOH, MOM, those guys, the official bodies, you need to already get a lawyer involved to respond to them. So there's costs involved with that. So the insurance is there to cover those legal fees. If you're sued, if you get served with a lawsuit, you've got to get a lawyer involved as well, right? You need to get someone to help defend your case. And so again, these costs start racking up, and then it goes to court. And then what are the judge might rule something and say, okay, you need to pay $250,000 as part of the settlement. That's what the insurance is there for. It's really to pay for those legal fees as you're ongoing to prepare your defense and that settlement costs. So you can really think about it as the D&O is there to cover your legal risk, your personal legal risk, or the company's legal risk for these wrongdoing acts when it comes to managing the company. The insurance companies usually also put in a sublimit for certain things. So I talk about company mismanagement. It's very wide ranging. I talked about misrepresentation, breaching laws or regulations. But what the insurers also do is they set a sublimit. And usually the sublimits are put in place for certain types of areas of where this wrongdoing can happen. One of them is employer practice. So that's anything related to claims of your liability as an employer to your employees. So employees might claim certain things like, oh, I was refused a hire. I was not promoted and I should have been promoted. I was discriminated against. I was dismissed unfairly from my job. Anything related to this employer-related liability, insurers usually put a lower sublimit in. Maybe I need to take a step back here. So when we talk about insurance coverages, there's usually an overarching policy limit. Let's say $1 million. That's generally kind of like a good limit to have, because it will cover you for most things in terms of the legal fees. But then for employer practice, they go, oh, we think that's a higher risk, that more claims will come out of that. So we don't want to give companies all the way up to $1 million for these sort of claims. We'll cap it at $250,000, $200,000, whatever. So insurers use that as a way to for their own personal risk management. They're not paying out hundreds and thousands of dollars in claims. So that's very common that we see employer practice as a lower sublimit. applicable to you guys on the line today, but this is like taking care of your staff. I guess because most of all us, work in an office, either at level 3 or wherever else, a standard kind of desk job. But if you're employing people that are a bit more have a more manual labor kind of slant to their jobs, working with heavy machinery and all that kind of stuff, as an employer, you need to make sure the environment is safe for your employees. And there are all these OHS standards that you need to follow. So if you're breaching one of those, or if your employees are claiming based on that, insurers usually put a sublimit for that again, so that you don't have the full 1 million cover, but you have a lower cover. So that's all kind of related to what D&O is there for, really to protect you as a director and the company for these wrongful acts when it comes to managing the company. And then a lot of the time what we're seeing is insurers are also giving like extra covers to the policy, one of them being crime. So if your employees steal from you, or if third party steals from you, whether that's like physical cash, if you had cash on in your premises, or I don't know, digital assets, all that kind of stuff, that gets covered under a crime. That's got nothing to do with how you manage the company as a director, but it's kind of like an extra freebie, if you like. Something else some insurers offer is something called mitigation costs. And this is quite an interesting one. And I think potentially really powerful as well. So, insurers don't want to be paying out large legal fees and settlement costs. They don't want things to go to court, because once they go to court, the fees rack up really high. So what some of them offer is mitigation costs. So if you get made aware that there's potentially a claim coming, a client, a stakeholder like a shareholder, an investor, a supplier, any sort of stakeholder, they're grumbling and they're threatening that they're going to sue you or whatever, potentially there's a way to mitigate that. There could be a way to pay a consultant or something like that to help rectify the situation, so that it doesn't actually end up in a full-blown lawsuit. So some covers, some of the D&O policies include like $100,000 or $200,000 worth of cover for this mitigation cost, which you're entitled to use to prevent a lawsuit from actually happening. I think that's a really cool thing to do, because it's also in your interest that it doesn't go into a lawsuit. So it's very good that insurers are thinking more about how you can reduce some of these risks. And just a side note here, this is something that you need to get approval from the insurer before you go start spending this money. But that is a nice extra cover to have. And then the third extra cover that's really common as well is expenses for public relations. So if you do end up in a lawsuit and someone finds out about it and writes an article, whatever, it goes on, I don't know, E27 Tech in Asia, whatever, and you want to do damage control with the PR, there is expenses you can use as part of the policy to work with a PR firm to help you with that communication, to lower that reputation damage that you might have as a result of one of your D&O claims. So that's in general what D&O covers, really there for your legal costs, but there are some nice extras included in general. Then what's excluded? Okay, so when we talk about wrongful acts, it all has to be unintentional, non-fraudulent. So what's excluded of the policy is fraudulent claims. So fraudulent activities. So as a director, you're trying to defraud the company, you're intentionally embezzling the funds of your company and buying your own private yacht or whatever, some of these crazy claims we see in the media sometimes. So those things are pretty clear, they are excluded. the policy is really there for unintentional acts. Oh, I didn't know about this it was an oversight, a mistake. That's what insurance is there for. It's really not there for you to use it as an excuse to do all these fraudulent acts. Another one that's excluded is property damage and bodily injury claims. So if as a result of whatever business you're doing, you've damaged property. For example, some of you on the call today will be working out of the level 3 co-working space. If you accidentally damage a wall, a window in that property, that's not covered by this policy. Or if someone's hurt, maybe your business is, I don't know, IoT type products or food related, or and someone's using the actual product that you produce and it's hurt them, it's burnt them, it's exploded, whatever, and they've had a claim where there's been bodily harm, that is not covered under this policy. Generally, a property damage and a bodily injury claims, those are covered under a public liability policy. That's a much more general policy to cover the company in case of accidental damages like that. So that's not a D&O, that's covered under something else. Ongoing litigation, so if you already have a lawsuit going and then you take out a policy, the policy is not going to cover your ongoing lawsuit. That's going to be, the policy does not cover previous acts. It's from going forward. One thing that's really common is, a common exclusion is founders suing each other. So we'll go into it a little bit in a couple of slides later about who's covered under the policy and who can, typical claims that stakeholders that can be claiming against you. What insurers do not want to cover is founders suing each other. So you can't have a dispute with your co-founder and be like, oh, I'm suing you, you've done something wrong, and then it does not get covered by a D&O claim. The reason is the insurers like to put a limit on the shareholding percentage of like one party suing the other. So it's fine to have minority shareholders sue. So let's say you've got someone who's got like 5-10% shareholding in the company and they're upset in the way how you're running the company and maybe make a claim that you've done something wrong. That person sues you, the D&O policy kicks in and will cover you for that because they're a minority shareholder. Usually founders aren't minority shareholders, usually have a higher shareholding, and so they don't like that because, yeah, the cover is not there for you to pick up on internal disputes like that. Another one that's common and very common exclusion and quite applicable for startups is anything related to insolvency. So insurers find startups very risky. I mean, we all know startups are risky in general. You know, what are the stats? 90% of all startups fail within the first 5 years or something like that. And because of that, insurers put in an exclusion around insolvency. So if your company goes insolvent and then someone sues you for that because of the insolvency, it's automatically excluded. So those are the common exclusions that we see in most insurance policies for D&O. Okay, I just saw there's a question come in, so I thought maybe I'll go through that now. So most insurance voids if the insured is found to have done something illegal, knowingly or unknowingly, but this insurance should presumably be there to pay for your defense should you be accused of something illegal. Yes, so what if you actually lose the case? E.g., something you thought was above board turns out not to be. do you then have to pay back the legal costs to the insurer as well as whatever penalties? Yeah, so that's a really great question. And we see this a lot with, well, I mean, you see these sort of things in the media, at least, claims of like money laundering, what's another, like other fraudulent type claims that come up quite a bit. So as soon as you get an investigation or filed with a lawsuit, you call up the insurer, and the insurance kind of kicks in straight away. They pick up the costs from day one, and then and then when it's found that you're actually guilty, and hey, it was a fraudulent act purposely done by the director or whoever's named in the lawsuit, then yeah, that's when you need to start paying back the penalties. And maybe it's a good time to also talk about deductibles or excesses. You know, for every insurance policy, I'm sure you would have seen this with your own personal policies, whether it being motor, home, or whatever other insurance you have. Insurers always put in this deductible or the excess, and it's basically to weed out really small claims because they don't want to deal with small stuff. They rather, because claims cost them money, and they rather just deal with the bigger things. So what happens when, again, as soon as you've been served with the lawsuit notification for investigation, you need to just tell the insurer straight away. They either, if you have your own lawyer, you need to get that approved by them, because sometimes they want to vet that your lawyer knows what they're doing, that your lawyer isn't going to be extremely expensive. And if you don't have your own lawyer, you can use their panel lawyers. So they start working with them from day on once it's approved. And then it'll sort of start racking up until you hit the deductible. And then they'll say, okay, if your deductible is $25,000, okay, you got to pay up for the $25,000 now, and then everything else will just be covered up into your policy limit. So it's kind of related to your question, whoever asked that. Yes, like the insurance starts straight away, but then if then you kind of need to pay for the deductible, and if you actually do. If the claim that you have actually shows up that it was an intentional act, you know, you did something actually illegal, then you're going to start paying back as well. So hopefully that answered your question that's just come through. Okay, I'm going to move on to the next slide to talk about who exactly is covered under the policy. It's on an unnamed basis. So you actually take out the policy in your company entity's name, and it covers automatically all of your directors on there, whether the present ones, the future ones, your past ones, so some might be retired. They were all covered automatically, which is great because you don't need to have like continually keep updating who's active on the board and who's not. Also covers non-executive directors, and it covers employees who act in a managerial capacity. So for example, your HR manager, your finance manager, they might not be on your board, but you know, they are doing managerial type work. What's also great is the policy covers you for your parent company and all your subsidiaries automatically. So you don't actually need to declare all the subsidiaries. It automatically does that. And I think the definition of a subsidiary is the parent company needs to hold at least 50% of the subsidiary, and then it's automatically covered. And generally, D&O policies are covered, covers you worldwide generally. If you have exposure to the US, and I'll talk about that in a little bit, it raises the price a little bit more because North America in general is extremely litigious, so insurers are just really worried about claims. So you generally ask many, many more questions if you do have exposure to the US, and then the premiums go up. But it's As for who's covered by D&O policy, it's the company. So if the company is named in the lawsuit, so that's quite common, I suppose, in certain investigations, or with the employees suing the company, they might sue just the company rather than the HR person or the CEO. So it covers you for the entity, and also covers those directors if they are personally named. Okay, so when is the best time to take out this policy? D&O is actually really attractive to take out when you know you want to start fundraising, especially when you want to fundraise and appoint board members. So this is quite common for like a Series A, when you're looking to get VCs on board. And you know, VCs expect this. It's very, very common as part of the closing terms that the VC will say, you need to take a D&O policy. So I think it's quite an attractive way when you're going out to fundraise, going, hey, we've already got it in place. If you come on board as a board member, you have protection through our D&O policy. And I touched on this earlier with the regulations and the different industries, that especially in fintech and medtech, just because, you know, we're talking in Singapore, right, with MAS, it's just better to get coverage as soon as possible, because again, you're pushing the boundaries. You don't know what's going to happen, how these regulators view your products and your services. So if you're in those industries, you want to think about getting that pretty soon. Okay, just want to have a quick poll here just to get some interaction going. Want to get your opinion on who you think is the most common source of D&O claims to companies or directors. Like, do you think it's mostly the investors or the shareholders, customers, regulators, or employees? So you could just pop just write A, B, C, or D into the chat. Just want to get your view on who you think is causing the most source of the D&O claims. You can just type it into the chat, A, B, C, or D. Anybody want to give it a go? Have a guess? Thanks, Charles, for being the first one. Thanks, Amos. One more before I reveal the answer. All right, I'll put you out of your misery. It's D, employees, which was, you know, what I was alluding to in my previous slides. Yeah, they are the ones that actually cause a lot of the claims. And what I talked about on one of my previous slides about the sublimits, remember, for employer liability, the reason why there is a sublimit, why it's not, let's say you can't claim all the way to your full limit of say $1 million, it might be capped at 200,000 instead, is because so many claims come in for that reason. And so the insurers try to mitigate that risk themselves by lowering that limit. So yeah, D, employees. Okay, now I'm going to go through some typical claims. I already talked about this, about the investigations from the regulatory bodies. One that we're seeing quite a bit of nowadays is in regards to like MOM related employment acts, like not following those proper procedures. One that comes up quite a bit nowadays. So if you think about like, you know, in Singapore, you know, you need to interview X number of Singaporean versus foreigners, and if you're not following those procedures, you can get investigated. So that is one that comes up quite a bit. Investors being another stakeholder group that can potentially claim against you. You know, you guys are, as founders, part of the job is going out and trying to sell yourself as a founder, your company, you know, looking for funding, fundraising, investors and all that. Yeah, you know, that's the potential that investors come and say, hey, actually, you told me your company was going to do X, has this sort of financials, and then I've come in and like it looks totally different. So there's definitely a risk there and a potential for a D&O claim there. Talk quite a lot about the employees, unfair dismissal, all that kind of stuff. Yes, that's definitely a very, very typical D&O claim. So again, that risk obviously goes up for you if with the more number of employees that you have, obviously. And then customers, they're also another stakeholder group, right? And comes back to like another sort of misrepresentation claim that, you know, you said you marketed your company one way with the types of products or services that you offer, and maybe there was an error or an omission in the actual work done. And if that is seen as management's oversight, that fits into a D&O claim. And I'm being careful here to talk about management, because D&O, remember, is all about the directors and officers, or the, what do you call it? The management's liability. So if the claim is positioned as management's, there was no management oversight in how the marketing materials were given, or the services rendered, that falls under a D&O claim. I'm hosting another of these webinars in a month's time to talk about professional indemnity, and that is very applicable for companies that are selling services and products, like consulting, SaaS products, all that kind of stuff, for claims that there was errors and omissions in the services that were sold to the customers. So that's something that maybe you guys want to come back for in a month's time. It's a little bit different to this. That's regarding the professional services. This claim here, with this particular example, is very much on management's liability. Okay, I've seen a question come in from Jonathan. What can be a threshold amount to invest in insurance? I don't quite understand your question, Jonathan, but I'm going to have a go at answering it. I think the way you look at insurance is how big your risk, how big you think your risk is. So I talked about on this slide about, you know, your risk goes up with the more number of employees that you have. That obviously means there's higher risk that more employees could be suing you. So, and you also need to look at things like, if you're in fintech and if you're regulated by MAS, what are the sort of fines being paid out there, versus if you're in just let's say you're a consulting company, not regulated, maybe you're a recruitment company instead, you don't have that risk of a regulatory body that's really, I suppose, looking after your sector so much, specific to your sector. So maybe the risk is a little bit lower. Then you also need to look at things like, how much do lawsuits cost in Singapore? And we see the typical amount to be around starting from 250,000. So I mean, if you look at all of these things, like how much would you be paying out of pocket, that's where you kind of choose what limit do you go for. We think the smallest limit to get would be 500,000. we think that's really, really the lowest limit that a startup would look into getting. 500,000 or otherwise $1 million if you're like if you're around a Series A, we'd say at least $1 million. If you're still at the seed level, I think a 500,000 limit kind of works. So I would think about insurance from that sort of terms, like what limit do you think you need to cover your particular company and the risks that your company has, rather than the question's disappeared, so I can't see it anymore, but what the threshold is for how much you're willing to pay out. Because I think it's all about the risk to your particular company. And that's something we can talk about. Azra mentioned at the beginning of this that we'll be doing these advisory sessions. We can have a chat specifically about your company, what industry you're in, how many employees, like what are the key risks, and we can talk through that if you like, Jonathan. What I'm going to move on to next is, what do insurers look out for when they're underwriting these policies? D&O is an insurance product that most insurers underwrite. Most insurers that do commercial insurance will look at D&O, will underwrite D&O, but they all have different risk appetites. And it's really interesting to see which insurers like what sort of risks, right? So number one is all around industry. There are difficult industries. I keep talking about fintech and medtech. I just want to say up front, if you're in a crypto, digital currency business, it is extremely difficult to get you D&O cover. Insurers are scared of it. I think also because the regulators don't really know how to deal with it, and there's no regulations around it. Because of that, insurers are scared. So it's not impossible to get, but it's extremely difficult. It can take a couple of months to get a quote, and potentially you need to go to, depending on how big the company is, it might not be underwritten out of Singapore, it might have been underwritten out of London. Like it's difficult. We've tried to help someone, and I think the premiums were like really like at least 20 to 30,000 Sing, right, for the premium. So crypto is extremely, extremely difficult. So that's kind of one thing. They like to see what industry you're in. They also like to see your total consolidated assets. That gives them an idea of how big your company is. I mentioned exposure to North America earlier, and the litigation costs that exponentially go up in North America. So that's something that they take into consideration. They like to see, like, what are you doing in North America? What's the business you have? What kind of activities are you doing? I think even the state in the US makes a difference with the pricing, because some states, I guess, have, some states in the US have higher legal fees or are just more litigious than others. And they also want to know how many employees you hire in North America as well. And a lot of them want to see your last audited financial statements. And this is to see, are you profitable or not? And hey, guess what? Most of the time, startups are not profitable, but they still ask for that. So in general, it's quite a pain to traditionally get a D&O policy, because you've got to fill out all this stuff. And if you don't know where to begin, you don't know which insurer like startups versus big corporate companies. So we realized at Anapi that was a friction point. So what we've done, we're a corporate agent in Singapore, and we spent a while trying to find insurers who like startups, because we're trying to serve the startup market, small business and startup market. And it was out of however many, 40 to 50 insurers around Singapore, we made that list, shortlisted down to 3 or 4 that actually have appetite for startups. And based on that, the next thing that was really important to us is not just startups, but ones fintechs and medtechs, because that is a huge booming sector in the startup scene, right? So many fintechs out there, so many health tech, medtechs. So we want to be able to find an insurer who can actually underwrite these companies. So that was key. And the other key thing for us is an insurer who's willing to strip down the underwriting questions to make it as easy as possible. And so we've done that. We found that partner. They're called Dual Asia, and they're backed by MSIG Insurance. So Dual's a very specialty underwriter, and they have that appetite. And so we're partnered with them, and they're able to provide coverage on the spot through us on our website. So long as you're not a crypto company, you have a Singaporean legal entity without any exposure to the US or Canada, you can have coverage on the spot. And so that's what we're offering through our NLP site. So that actually really brings me to the end of the presentation. You know, this topic was all about safeguarding your business and actually your personal assets as a director. You know, being a founder, growing your business, it's all exciting, you know, trying to push the boundaries and disrupt. Really, really exciting, but don't want to be a Debbie Downer, but, you know, you want to make sure you're growing your company, but protecting it at the same time, not just the company, but your personal assets. And a D&O policy is honestly like a no-brainer if you are fundraising, if you're in one of these riskier industries, the fintechs and the medtechs. Like, that is something, honestly, I believe every founder should be getting, even though you may be small, you may be only seed funded, but we're just seeing so many more things happening. And if the US, North America being sort of a prelude to what's coming to Asia, is there are so many claims going there. Insurance premiums are going up there because of all those claims. It hasn't hit us in Asia yet, so I mean, premiums are relatively low still, but it's coming. It's because I think people are just becoming more litigious. And to the point earlier, you might not have done anything wrong, but there might be a third party out there who just wants to, you know, get you out for whatever it is. And that's the thing, like, you could have done everything correctly, but you still face an investigation or a lawsuit. So yeah, I just wanted to share this with you guys, that this is really one way to safeguard your business and your personal assets. So love to open it up to questions. Thank you for those who already put in some questions on the chat. I don't see anything else coming in right now, but yeah, we can have a little pause for questions here. Also, on my last page, we have a site, the anapy.co, that's our website, and /DNO, that is our landing page. I talked about the Dual product, that's up there, so you can read about that there. It's we do offer 500,000 limit and a 1 million Sing limit. It's actually one of the cheapest on the market. It's 1,700 Sing for the $1 million coverage. Extremely simple to get straight through coverage on the spot. Okay, we've got a question. Is there an alternative to safeguarding businesses without insurance? Yes, I mean, you can put all the controls in place, right? As much as you can. So that would be, if we look back at the types of claims, I'm just going to go back a bit. Here, let's take these examples, right? You can have proper hiring, firing protocols in place for your company. We go back to this whole employer practice liability, and make sure everyone follows them, from your HR to every sort of hiring manager. You can make sure you don't misrepresent any information, right? You can have put in proper contracts in place with your investors. Yes, there are all so many things that you can and should be doing. That's the whole point, right? You should be doing all these. It's like just basic governance that you need to be doing that will reduce your risk. If you don't have these protocols in place, your risk definitely goes up. But the fact is, I think it just comes down to like mistakes happen. And if you are really pushing the boundaries, if you as a founder really want to push the boundaries, really want to disrupt, you also don't want to be held back in a way. And I think this comes with the slant of when you get investors on board. You know, if you get a VC who's very aggressive, who comes onto your board and, you know, they all of a sudden want you to grow by how many percent more, they're just putting a lot more pressure on you and the company. And how are you going to get that, right? You have to push the boundaries. And a D&O policy is your security blanket. Not saying you get it and then you just go wild, because again, you know, we talked about these exclusions, like you can't be doing intentionally bad fraudulent acts, right? But it's a good safety net to say, you know what, I can push the boundaries. We can do all these things. Think again of Uber, like they were pushing the boundaries. They said, you know what, basically they said, stuff you, taxi industry, we're going to disrupt you, we're going to have our own ride sharing platform, we're just going to do it, right? And they kind of like steamrolled their way through it. They're able to do that because they have a security blanket. And so that's how I guess I want you guys to think about it as well. Yes, you can be safeguarding your business, putting in protocols and controls in place. That's a given. Like you should anyway be doing that. It's just if you want to take it to the next level, if mistakes happen, you know, you've got this safety blanket there for you. And as I mentioned before, like if a third party wants to sue you when you've done absolutely nothing wrong, there's nothing preventing them from doing that, right? But you still need to defend yourself, and that's a claim in itself. Great questions, guys. Are there any more that you have that you want to ask right now? Okay, so we have another one. Does the safety blanket, i.e. I guess the insurance, only cover everything from the time it was placed? Okay, great question. So with the insurance policies, there's what we call the inception date. And the inception date is when the insurance starts from. So let's say you want to start the insurance from 1st of March. So that's one date called the inception date. Then there's a date called retroactive date, and that's something you might see on some insurance policies, and you see it on D&O policies as well. So with the retroactive date, what that's saying is you could have a date unlimited, for example, or 1st of January, or whatever the date you started the company. And it's basically saying, let's say your policy starts on the 1st of March, but you get a claim, and then, so say on the 10th of March, after the policy is effective, you get a claim that comes in, someone claims that, oh, there was an unfair dismissal back in December 2020. So because if you've had a retroactive date that's unlimited, for example, that claim would be valid and would be paid out because the incident that happened took place before the policy inception date. So with the policy that we are distributing through our site, this dual one, we have an unlimited retroactive date. So if you take out a policy for 1st of March and exactly that scenario happens, it would be covered because the retroactive date is unlimited. That's something to look out for because not everyone does that. Not all insurers do that. They usually like charge more as well because obviously for the insurer, they're opening up an even wider time horizon for when claims could be accepted. So that's a really great question. And also, insurers do that because sometimes claims take a long time to actually surface, right? There could have been an incident months and months ago, but then they don't actually do anything about it 6 months, 1 year down the line. So that's a really useful thing to have, this unlimited retroactive date. Okay, any other questions? If not, Azra, shall I hand it back over to you?
Okay, so I'm just going to be showing the link to the advisory clinic. So Ruth has kindly freed up a few hours of a day tomorrow and also on Friday. So we do have a few slots only, first come, first serve. So if you are interested to have a one-on-one discussion or just any more questions that you would like to ask Ruth, you can do so in the link here. If not, then thank you so much for your time today.
Oh, sorry, Azra, I just seen one more question's come in. So if a company
Okay,
takes
cool.
professional indemnity insurance, there's a directed need to take up D&O also. Great question. I did mention earlier that professional indemnity is also a legal, protects for legal risk, and that's more on the services that the company delivers. So that's more errors and omissions related to the company's services. So example, SaaS companies, you're providing whatever advice, AI, and because of your services, your clients have an economic loss. So they took your advice and you know what, they've lost money on that. That's a PI lawsuit. That versus D&O being around management's liability. So I really think there is a need for both, because there is always a gray line between some D&O and some PI risks. And the problem we have with insurers is that they don't like to pay claims. I think that's not a secret, right? We know that personally from our own personal insurance, I'm sure. And they will say, oh, that's a professional indemnity claim. That was the company's fault for an error or an omission. Or they might say, oh, but it was management's fault. Management didn't have the right oversight on this. At the end of the day, management was responsible and it was their liability to make sure whatever service was done properly. So I know it's like obviously more money to buy insurance, but hey, we can have a chat through the advisory clinic to see exactly what sort of industry you're in, what are the risks. Maybe PI is actually more pressing for you because you've got enterprise clients, and that's what I'll talk about in the next one of these webinars. Like, when is it really important to get it? I think you just kind of need to look at the situation and what industry you're in. But yeah, they are quite separate things, but the insurers make it difficult when it comes to claims, unfortunately. So there is always this grey zone between the two. So it is recommended to get both, but happy to discuss and see what your situation is, and maybe you don't need actually both at the present moment. Okay, Azra, I feel like we've got some questions around Link.
Okay, I will be sending in a follow-up email to the link as well, to the Calendly link, and then you can register from there. So sorry for the technical issue. Is that okay?
All right, so Azra, you'll send out the links, and then that link will be for the sign up for the advisory clinics. And that's, we've got slots for tomorrow and for Friday, right?
Yeah.
Okay.
Yes.
Okay, great. And yeah, I just want to plug my next webinar coming up. As I think it was the 17th of March, if I'm not wrong, right? In exactly a month's time.
Yeah.
The 17th.
Yes, 17th of March. So it's in a month's time for the next and last part of the webinar series.
Yeah, exactly. And so that one will be focused on professional indemnity, which I just mentioned is quite similar, but a bit different, a bit of a slant. So that one's really applicable. Again, you say if you're a SaaS company, if you're doing software consulting, I don't know if there are any of these sort of companies, but even like gyms, fitness consultants, counselors, all that kind of stuff, that's really applicable. So it's the legal risks involved with an error or an omission in the service that you provide.
With that, I will be sending the follow-up email with the link. And then, yeah, thank you so much, everyone, for joining.
Thanks, everyone. Hope to speak to you soon.
Thank you.